Welcome to the Real Estate Deep Dive with Paul D. Garrison from JP and Associate Realtors. Today we're going to be discussing the impact of rising mortgage rates on the housing market. I keep getting asked, what's going to happen to the housing market as we see these rates rise like they have just in the past couple of weeks. So while no one has a crystal ball and can know for sure what the housing market's going to do, what we can do is we can look at historically what has happened when rates have risen in the past. So let's start out by taking a look at how mortgage rates have risen since the beginning of the year. So this data is from Freddie Mac. It's looking at the average 30-year fixed rate mortgage rate from the beginning of January all the way through to the end of March. So as you can see, we started out at about 3.11% and have pretty steadily climbed until the end of March, where we hit 4.67%. And again, this is the average for the 30-year fixed rate. Depending on credit score and some other factors, you may be getting quoted something different from your current lender. So a lot of people are wondering, well, why are the rates rising, especially in the last couple of weeks, so dramatically? Well, this quote from Freddie Mac may help shed some light on that. Mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. Much of the increase in rates in the early 2022 is in anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. So probably one of the biggest questions that I get is what's going to happen to home prices as rates rise? So what we're looking at here is historically what has happened to home prices whenever mortgage rates have gone up by greater than 1%. So this data goes all the way back to October of 1993, so basically almost 30 years. And what we can see is there's an average increase of about 8% in home prices whenever the interest rates go up by greater than 1%. So what that definitely helps show us is that rising interest rates does not tend to have a negative impact on home prices. So let's look at the same data and time period and what happens to home sales whenever interest rates go up by greater than 1%. Well, we can see that the average is actually a negative drop in sales of about 5%. But again, looking at the individual years, we see that there's really two outliers that are some large numbers. And one of those is June 2005 to 2006, which is kind of the precursor before the last housing crash. The other one is back in October of 93 to December of 94. So let's drill down a little bit on that from back in 93 to 94. We actually saw an increase of 2.38% in the interest rate with a final rate of 9.2%. This is vastly different from what we're seeing in the market today. So the key thing to remember here is that we're not projected to see a final rate of around 9%, and we definitely aren't seeing a 2.3%, almost 2.4% increase in the rates either right now. Given that that's such a vastly different market than what we're looking at today, let's go ahead and take that one out and just focus on the other remaining periods. So what you'll see there is primarily a little bit of orange, a little bit of black. You really just either a plus or minus 2% change in this home sales. For the most part, negative. But there is the 1 year and from 03 to 04 where we actually saw a positive increase in home sales. So of course there's still the one outlier there from 05 to 06 where it's a negative 14% drop in home sales. But again, that was, as I mentioned, leading up to the last housing crisis. If we kind of factor that out as well, we see that overall, changes in interest rates don't seem to impact home sales that greatly. So really, the question begs is, if interest rates don't have that big of a impact on home prices or home sales, why is that? And what we really need to look at is kind of inventory or the amount of supply that we have in the market. So I know we've all been hearing a lot about supply and demand and how tight the supply is as far as the amount of homes that are on the market. We are at historically low levels. I mean, actually even lower than we were a year ago. And what that does is that keeps an upward pressure on prices. So that's why we're seeing forecasts that homes are going to continue to increase as far as prices go, because there's just not enough homes on the market to meet the demand that's out there. For that reason, I want to kind of layer in the inventory levels during these periods. Now, we don't have it going all the way back before 2000. We have it back to about 2003. So we'll get to take a look at those, and then I'll show you here locally what we're seeing in our current inventory levels. So what we were seeing during these times, especially like the 05 to 06 period, we're seeing about 4.5 months of inventory, going all the way up to 5 months of inventory. So we're in a vastly different market again as far as inventory goes than what we're in today. So here's the inventory level for the 4 major counties here in DFW. You can see that they all are under 1 month of inventory, ranging from 0.6 to 0.7 tenths of a month. So again, a vastly different market than what we were seeing in the past. Really, I think if we see any articles or anything about the softening of the sales numbers, I think it's really going to be due to the low inventory more than anything else. There's just not enough homes out there for everyone to buy that they want to buy, so we're not meeting the true market potential. So let's take a quick look at what some of the other experts in the industry are saying about mortgage rates. So here's a quote from the Director of Forecasting of the National Association of Realtors. While higher short-term interest rates will push up mortgage rates, I expect some of this impact to be mitigated eventually through lower inflation. Thus, I expect the 30-year fixed-rate mortgage to continue to rise, although we aren't likely to see the big jumps that have occurred over the past few weeks. And here's another one from Freddie Mac. History suggests that when rates rise, there is an initial bump in home prices as many move quickly to buy a home before rates increase further. But after that period, home prices slow. Freddie Mac analysis shows that a 1% increase in mortgage rates results in a home price appreciation that is 4 percentage points lower. For instance, a 1% increase in mortgage rates would change home price growth from 11% to 7%. So to kind of summarize what they're saying here is they're not expecting depreciation in home prices due to the rate increase, but what we are likely to see is a bit of a softening of the home price appreciation, or a deceleration of the home price appreciation. So I'd like to end this presentation with a quote from the Deputy Chief Economist from Freddie Mac. With rates rising and expected to rise through 2023, it makes sense to obtain a purchase or refinance mortgage if you're in good standing. Many of the metrics and numbers in this presentation are based off of the national real estate market. However, local areas can vary. Please give me a call and we can discuss your situation. Have questions about your specific needs or location? Please contact me at 214-683-8188 or paul@pauldgarrison.com. Want more information about the housing market and related issues? Be sure and check out my blog at www.pauldgarrison.com. Thank you for your time. Please take a moment to visit our website at www.pauldgarrison.com.